Chapter 13, At-Risk and Passive Activity Loss Rules, as well as the Individual Alternative Minimum Tax. Learning Objective 1, At-Risk Rules. And it's important before we take a look at the content on this slide to talk about what we mean by at-risk. So when we are forming a business venture, a lot of times we're going to do that either by contributing property to the business venture or contributing cash. What the at-risk rules here are going to be discussing is the amount that we as a participant in this business venture are exposing ourselves to. So if we put up $10,000 for the business venture, we would think about having $10,000 of our skin in the game or our money at risk. Now, as far as what activities we're talking about, here we're talking about being engaged in carrying on a trade or business for the production of income. And it's not going to matter in this instance whether or not we're materially participating in the business or not. It's just that we are engaged in that trade or business, and that it's the initial amount that we are putting at risk, that contribution that we have of money or else property that's going to be considered in the calculation for our risk amount. So if we consider property, we're going to take a look at the adjusted basis of the property that we contribute, and that amount is going to be considered our at-risk amount. And then the basis in cash is going to be the cash value itself. So if we put up $10,000 in cash, we're going to think about it as having a $10,000 basis. So we'd have $10,000 at risk there. So once we put up more cash or property contributions, that's going to increase the amount that we have at risk. We may also take over a share of liabilities, which would increase the amount that we have at risk. And then as the business venture has income or has gain items, that would increase our at-risk. Conversely, our at-risk amount can decrease. So if we have cash or property distributions from the business venture to ourselves, getting cash back is going to decrease the amount that we have at risk. We're going to get some of our money returned to us, and it's no longer going to be at risk in the event that the business were not to succeed. And similarly, the same way that taking on a share of liability gives us more exposure and puts us more at risk, our release of liabilities will decrease our at-risk amount. Now we're going to file the Form 6198 for each activity subject to these at-risk limitations. And with respect to liabilities, we've got three different types of debt that are going to be able to affect this at-risk amount. So we've got recourse debt, and that's going to mean that we can be personally liable for that debt. So the business may take on liability. We have a share of it to where if the business does not pay, we would step into that place and pay. Non-recourse debt is going to be an amount to where the business venture may be liable, but we're not personally liable for it. So we're not going to have any ability for non-payment for us to have to step in and make that payment. And then we've got qualified non-recourse debt. And a lot of times what we're talking about here is if the debt were to attach or have a lien on something like real property, then that may qualify the non-recourse debt for these at-risk rules. And losses are going to be disallowed under the at-risk rules are going to be carried over indefinitely. So if we're not allowed to take the loss in the given year, we're going to push it forward or carry it over. And then it's going to be deducted in years when the at-risk amount increases. And losses may still be subject to the passive loss limitation. So we're going to take a look at that coming up in this slide presentation. But we've got two sets of rules they're going to be placed upon us, the at-risk rules as well as the passive loss rules. So for the at-risk rules, let's take a look at our first concept check here. It says, which of the following items will increase a taxpayer's at-risk amount? And then we've got cash contribution made by the taxpayer into the activity, taxpayer's share of income from the activity, and taxpayer's share of activities liability for which the taxpayer is personally liable, so that recourse debt. That's going to be D, all of the above. And which of the following types of liability does not increase the taxpayer's at risk in an activity? So we've got our non-recourse debt, and qualified non-recourse debt. Recourse debt, we're stepping into that exposure and by making yourselves personally liable. And qualified non-recourse debt, our property is essentially doing the same thing, to where the real property is going to be subject to that lien. So non-recourse debt is the only one that the venture may be liable for, but we have no liability either indirectly through property or directly through personal liability. So the answer here is going to be A, the non-recourse debt. Concept check 3. When a loss is disallowed by the at-risk rules, which of the following is true? And the answer here is going to be C, the loss is indefinitely carried forward. So learning objective 2, passive activities. So what is a passive activity? And here it's going to be where the taxpayer does not materially participate on a regular, continuous, or substantial basis. And we're going to see a set of 7 different rules that we're going to take a look at to see whether we can qualify as a material participant. Now, most rental activities and limited partnership interests are going to be passive by definition, but we're going to take a look at these 7 tests that are going to be used for material participation in one of those ventures. So the first test is if we are in our business venture and are participating greater than 500 hours, then we meet the test. We materially participate. The second is going to be all the participation in the activity. So we may not meet the 500-hour rule, but there's no other participants. We are solely participating in this activity. We've done everything that we can for our business venture, so we're going to meet that test. We may have other participants involved, but if we work greater than 100 hours and we are the one working the most hours, then we're going to be deemed materially participating. And then if we have multiple business ventures and we work greater than 100 hours in this business venture, and that the aggregate of all the time we're putting into all of the business ventures is greater than 500, then we may materially participate in this business venture. And then we've got a couple others that are largely relevant for those participants that are in retirement or kind of phasing out, but we are going to be deemed materially participating if in the last 5 years of 10 years we participated, then we're going to have met the test for the current year. And we're going to be deemed materially participant if for any of the last 3 years for a personal service activity. So this is something like a legal practice or maybe an accounting CPA firm. And then there's also facts and circumstances. If there's an extreme situation that is worthy for material participation, there's wiggle room to take a look at that and for the IRS to agree that under those facts and circumstances, that it may not fall into one of the other 6 tests, but given this situation, we will permit it. So what is the general rule for this passive loss? So passive losses are only allowed to the extent of passive income. So we're going to separate that income and loss into passive or active income or loss, and then the portfolio income. Now our passive losses can't offset income for either portfolio income or active income. And then as mentioned before, rental activities are usually going to be deemed as passive irrespective of that material material participation test. Rental activities being what you typically would think of as a landlord-tenant arrangement. The exception here is going to be for a real estate professional, to where if that is the trade or business for the venture, then you're going to be accepted for that, and then would go through for the material participation test. And then there's 6 other instances in which rental is not going to be considered passive as well. Here we have rental period less than 7 days, 30 days or less for the rental period, and significant personal services. And what we're typically thinking of there is maybe a hotel venture or something along the lines of a hospital maybe that provides medical services, which is a personal service. But you may still stay for a few weeks in a hospital bed, which is kind of like renting a hospital room out to you. These are going to be deemed as not rental activities, but as the trader or business. We've also got extraordinary personal services, incidental to non-rental activities, customarily available during defined business hours and rented to an entity the taxpayer owns. For those rental activities that we're talking about, there is a $25,000 loss allowed for them and for active participation in owning at least 10% of the property. This permitted $25,000 loss is going to actually phase out once AGI reaches $100,000 through $150,000. So there's going to be 50 cents per dollar that's going to phase out during that $50,000 range. Now, an exception to this is going to be disposition of the passive activity in a taxable transaction. Passive losses are in this situation going to be allowed against non-passive income. And then suspended passive losses are going to be permitted as well. So if we are selling off the business that has these accumulated losses, we're going to be able to take them at that point. However, this needs to be in a taxable transaction. So a gift or inheritance would not trigger the use of those suspended losses. So let's take a look at our first concept check here. Rental properties are almost always considered passive activities. That is true. The general rule concerning the deductibility of passive losses is that they can be deducted only to the extent of passive income. And that is also true. Question 3. For low-income taxpayers, passive rental losses can be deducted against other income up to a maximum of $50,000. And that is false. And then generally suspended passive losses can be deducted against other income when the activity is sold or disposed of. And that is true. Learning objective 3, the at-risk and passive activity loss rules are applied in conjunction. And the way we're going to do this is recognize that they are two separate rules, and both for similar purposes in terms of preventing tax sheltering structures. And they're going to be ordered in terms of the at-risk rules are going to be applied first, and then the passive activity loss rules are going to be applied second. And in order to use these losses, we're going to need to meet both tests. So we're going to file Form 6198 for each at-risk activity, and then the Form 8582 is going to be for all passive activities. If we do not meet the at-risk rules, then we're not going to even get to the passive activity loss rule. So those are not going to come into play unless the loss is first allowed under the at-risk rule. So there's two sets of rules here. And we need to have our loss allowed under at-risk first. And then if it's allowed under at-risk, we then need to have it allowed under the passive activity losses in order to utilize that. So taking a look at concept check for learning objective 3 here. Our first one says which rules are applied first to the passive activity, the at-risk or the passive activity loss, and that's going to be the at-risk rules. And then once it's allowed under those, then the passive activity loss rules are going to be applied, and it needs to survive both. It needs to be allowed under both in order to be used. 2, why must suspended passive losses from several passive activities be allocated among those activities? And the reason why is we don't want to kind of move losses around between those activities. So what we're going to do is allocate them among those activities and kind of freeze them there. That way if we dispose of one piece of property, only the allocated loss to that activity is going to be permitted. Number 3, if a taxpayer has an adjusted gross income of $105,000 before considering a $23,000 loss from a rental activity, how much can the taxpayer deduct from the rental activity, if any? And here that phase out is going to come into play. Ordinarily, we would be permitted up to $25,000 for the loss for a rental activity, $23,000 loss. We're under that, but there's a phase out that starts at $100,000. So we're going to apply that test and see. So we would phase out the 5,000 would be over, so 50 cents per dollar that we're over, so 2,500 would be disallowed. So instead of the 25,000 would be permitted, we're only permitted 22,500. So we would meet that constraint with our $23,000 loss. So 500 of our loss would not be allowed here. We'd only be allowed $22,500 of that rental loss. Learning objective 4, alternative minimum tax. Now the alternative minimum tax is a tax that is going to be subjected to taxpayers in the event that the amount they otherwise would pay is below the threshold. And the example that you can think of here is if we have extremely high income, high earning taxpayer, but they may give they may be able to take a significant amount of deductions for either charitable purposes or for state and local income taxes that are paid. They may be able to use those deductions to reduce taxable income to an extremely low amount. Congress said that seems unjust and unfair, to where even though the code is designed to allow you to do this ordinarily, if it's done to such an extreme to where you have nearly no taxable income or nearly no taxes paid, it seems like an injustice not to participate in the tax payment part of the collection. So we are going to subject you to an alternative minimum tax in that instance. The formula we're going to look at to calculate what that alternative minimum tax would be is going to be the regular taxable income plus those exemptions and standard deduction to get back to the amount. And then we're going to add or subtract adjustment items, and then we're going to add in the tax preference items and subtract any exemption amount. So a certain amount of this income is going to be exempt from the alternative minimum tax. Once we do that, we're going to you're going to be subjected to 26% rate or 28% less 3,896. So this is kind of like the tax tables we've seen before, but we've only got two tax brackets that we're going to be looking at here: 26% and then a 28% if we're over the amount. So the tentative alternative minimum tax less the regular tax is going to equal the amount of alternative minimum tax that needs to be paid in addition to that regular tax. Now, after the 2017 Act was passed, some of these are going to be less important. For example, state and local taxes, which might have been significant in high tax areas such as California and New York. This 2017 Act limits those to $10,000 on Schedule A. So the maximum that needs to be added back on the alternative minimum tax calculation is going to be $10,000. So the difference between what's paid on the taxes ordinarily and what would be paid under alternative minimum tax is kind of converging and getting closer together as far as that goes. The simplification of other itemized deductions. Here we have medical, mortgage, interest, charity, and miscellaneous deductions are going to be treated the same for regular tax and alternative minimum tax purposes. So again, that's not going to be something that's going to have much of a contrast between it. So only those itemized deductions are going to be adjustments, will be taxes. We're also going to have depreciation adjustments. So we've got a variety of different types of instances here. For real property between 1987 and 1999, we're going to use 40 years for the life of all real property. Now, especially considering in some instances, the useful life may have been 39 years, so the adjustment to get to 40 years for the alternative minimum tax wasn't that much of a difference, but still a calculation that needed to be done. So now real property after 1998, we're going to have no alternative minimum tax adjustment. Looking at personal property from 1987 to 1998, longer life and method change to 150% declining balance. And then personal property after 1998, just the method changed to 150% declining balance for the alternative minimum tax. So the 200% declining balance is not an option for that alternative minimum tax. So you have to change the method to 150% and see what the difference would be. Some other adjustments that we need to make. There's a separate basis calculation we're going to do for gains and losses, and then incentive stock option adjustment as well. We're going to have adjustments from the K1 for any partnerships, and then long-term contracts as well. So long-term contracts being using the completion method specifically. And then tax preference items are not going to be much of an issue any longer. So those exemption amounts we talked about for married filing jointly are going to be in 2018 $111,700. For single would be $71,700, and if you're married filing a single, or excuse me, married filing separately, then you're going to have $55,850. So you're going to have essentially one half of that $111,700. And then the phase-out exemption is going to be reduced by 25% of the alternative minimum tax in excess of the income limits. So that is going to be for $510,300 for single and $1,020,600 for married filing jointly. And then we're going to split that amount in half for married filing separately and get $510,300 again. So let's take a look at our learning objective 4 concept checks. The first one, medical expenses are allowed in full, and that's going to be the same as for regular tax for our alternative minimum tax purposes, and that is true. Number 2, no taxes are allowed as a deduction for alternative minimum tax purposes. That's going to be true. 3, if a taxpayer is married and has 8 children, no exemption would be allowed for alternative minimum tax purposes. That's going to be true. And 4, if a taxpayer's alternative minimum tax is going to be if a taxpayer's alternative minimum tax income is $194,800 or less, the alternative minimum tax rate would be 26%, and that is going to be true. If we are over $194,800, then we are going to be in a 28% tax rate, but we would subtract out the amount for the alternative minimum tax income up to the $194,800. Mathematically, another way you could do that is just to subject the first $194,800 to the 26% rate, and then anything over $194,800 would be subject to 28%. So when we're subjecting the alternative minimum tax income to the 28% rate and subtracting the amount away, the amount we're subtracting away is just going to be the 2% times $194,800.